Is Frontline a buy or a sell? Let's get started with the model. This is a mid-cap company, 3.2 billion market cap. They're trading at $14.35 a share, and they have 223 million shares outstanding. Frontline is a shipping company. They ship by vessel across the ocean, and they transport crude oil and other oil products all over the world. Their current fleet is 76 vessels. They were founded in 1985, based in Cyprus. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Negative free cash flow in 2021, a small positive in 2022, a big negative in 2023, negative 775 million, even bigger negative in the trailing 12 months, negative 1.7 billion. They are profitable, as you can see here, but they're investing a lot into CapEx. And I've seen some forecasts where their free cash flow is $1 billion in 2025. Even if they get half of that, the stock seems really undervalued. Net income is the profit or loss on the income statement as revenue minus expenses. Negative in 2021, mainly due to COVID and lower revenue. Then they had a nice healthy profit in 2022 and 2023. Still pretty consistent in the trailing 12 months. The 547 million is right in between 2022 and 2023's number. Revenue is a sales for the company, and that almost doubled from 21 to 22, 1.4 billion, up another 26% in 2023, 1.8 billion, up another 13% into trailing 12 months, over 2 billion. So revenue is growing nicely, and they pay a massive dividend. This is correct, it's close to 14%, but they have negative free cash flow, so that means they need to fund their dividend with debt. They need positive free cash flow at some point to maintain this dividend. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 6.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.6 billion. We divide that by 223 million shares. And we get a calculated stock price of $20. They're trading at $14, so they're trading at a 30% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 45 companies in the same industry as Frontline, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend quite a bit in CapEx, 2.4 billion, a lot more than the 2, 4, 6, 8, 10 companies above it. And those 10 companies have a much larger market cap. Look at Cheniere, 10 times the market cap, and they spend a lot less in CapEx. When a company spends a lot in CapEx, that means they're setting up their future. So their future free cash flow should be enormous. Their CapEx is even larger than ONEOK, and ONEOK's market cap is 59 billion. They are a little leveraged, but they're equal to the median. This industry has lots of debt. Look at Targa, 5.5, EnLink, 5.1. This is a great industry to invest in if you want a nice dividend. I'm invested in ET, and I earn a great dividend. Frontline pays the highest, close to 14%. Nobody's even double digits on this list, but they have the worst free cash flow, negative 1.7 billion, because they're investing so much into acquiring new vessels. They rank 20th in market cap, far behind the top 10. Their price to book looks real good, 1.3. The only one better is Plains. They're the best PE on this list. Nobody's even single digits, and they're below 6. They're trading 6 times earnings. We can't look at their price to free cash flow. They have negative free cash flow. Price to sales is better than the median at 1.6. Price to sales is stock price over sales per share, or market cap over revenue. 2 billion of revenue. Look at Plains, 50 billion of revenue, and they rank 19th in market cap. They have more revenue than number 1 Enbridge. Frontline's 52-week low is 1334. They're at 1435. So it's getting pretty close to its 52-week low. It could be a great time to jump in. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be at $23,000 today, an 8.5% annual return, a 127% total return. The stock has done really well the past 2 years, as you can see here. For a while, for about 3 or 4 years, you would have been negative. I hate looking at my portfolio when I'm down. I love looking at it when I'm up. I could look at it every 5 minutes when I'm up. To summarize, I have them trading at a 30% discount, ranking 7 out of 10. Seems like a really good value. A great short-term trade, 7 out of 10, and even better long-term. I think this company has a great future. There's a lot of upside potential. Ratios look real good. They have the best PE, so 8 out of 10. Financial, 6 out of 10. Revenue looks great, but free cash flow has been negative and getting worse, so that's why it's not higher. Let's go through their third quarter presentation slides. This chart right here are the daily rates for this type of vessel. So 39,600 for VLCC, 39,900 for Suezmax, and 36,000 for Aframax. VLCC is very large crude carrier. So just by the name, you could tell what it ships, crude oil. The Suezmax travels through the Suez Canal. The Suezmax is larger than the Aframax, but smaller than the VLCC. Not all ships can pass through the Suez Canal. Some ships are too large, so they have to avoid it, or they have to unload some of the cargo to another vessel before they go through the Suez. LR2 is long range 2. That is different than Aframax, but they are fairly similar in size, so they group these two together. So these are the spot rates in Q3. These are the projected spot rates. VLCC is supposed to go up a lot, from 39.6 to 44.3. Suezmax is very similar to 3Q, but the Aframax is projected to go down in rates, from 36 to 34.8. So in the third quarter of 2024, profit of 60 million, an EPS of 27 cents, revenue 490 million. They paid a dividend of 34 cents per share, which is more than their EPS. Their EPS is 27 cents. Their adjusted EPS is 34 cents. Adjusted means they strip out non-cash items, certain non-cash items like stock-based compensation. They did sell their oldest Suezmax tanker. That was built in 2010. They sold it for $48.5 million, and they delivered the vessel to its new owner a couple months ago in October. So after they paid down the debt on that vessel, the net cash proceeds were $36.5 million. So they had $12 million of debt on the vessel. They received $48.5 million of cash. They paid off the debt, the $12 million, so $36.5 million was left over. They fully repaid their loan with Heman Holding. They also paid $275 million on an unsecured revolving credit facility. So the total debt pay down between the two is $470 million. They entered into a sale and leaseback agreement for up to $512 million to refinance 10 Suez tankers. And that refinancing is expected to generate $101 million of cash in the fourth quarter. If you're not sure what a certain term means, go to Investopedia. In the past, I used to go to this website all the time to learn certain information I couldn't understand. I still go to it, not as much, more of a refresher, but it's a great website. It explains things really clearly. The seller of the asset becomes the lessee, and the purchaser becomes the lessor. So an asset that was previously owned by the seller is sold to someone else, then leased back to the first owner for a long duration. This is a way for a business owner to continue to use the asset, but they don't own it anymore. So if they own a vessel, say the vessel's worth $100 million, and another company wants to use the vessel to ship oil. So Frontline can sell the vessel to this other company for $100 million, and then Frontline leases it back. So now this other company owns a vessel, but Frontline leases it back. When you lease an asset, like you lease a storefront, you don't own the building, but you have access to the store. They don't own the vessel anymore, but they have access to it as if they own it. I like this example. Another way of thinking of a leaseback is like a corporate version of a pawn shop transaction. A company goes to a pawn shop with a valuable asset and exchanges it for a fresh infusion of cash. The difference is that there's no expectation that the company would buy back the asset. They sell the vessel, get cash in the door, but they can still use the vessel as if they own it because they lease it back. The most common users of sale leasebacks are builders or companies with high cost fixed assets, like property, land, or large expensive equipment. So they're common in the building and transportation industries, also in real estate and aerospace sectors. Here's the income statement highlights. Their net revenue in the third quarter, $295 million. Last quarter was a lot higher because shipping rates were higher. And for all of 2023, revenue $1.2 billion, $59 million of operating expenses, $7 million admin expenses. So their EBITDA $227 million. Last quarter $340 million. For all of 2023, $1 billion. So their profit for the third quarter $60 million, which is 1/3 of last quarter. They do have a lot of debt, so they spent $69 million of interest on their debt. Here's the balance sheet highlights. $320 million of cash, $460 million of other current assets. Their main asset is their vessels, $5.4 billion. New building are vessels that are under construction, so that's still considered an asset. Only $112 million of goodwill. Goodwill is the premium you pay when you acquire another company. So that total assets $6.3 billion, down from last quarter of $6.5 billion. $400 million of their debt is owed within 12 months. They owe $3.4 billion of debt beyond 12 months. Assets minus liabilities equals equity, $2.3 billion of equity. Equity is the value of the company according to the balance sheet. And it looks like there's no meaningful debt maturities until 2027, so they have some time before they have to pay those big debt payments. They have one of the youngest and most energy efficient fleets. The average age is only 6 years. They have 41 VLCCs, very large crude carrier. Those are the big ships. Despite the current challenging spot market rates, Frontline generates decent positive cash flow. It's kind of a weak word, decent. Most companies would say strong cash flow or solid cash flow. Decent sounds like it could turn to negative at any point. With 30,000 earnings days annually, this company has substantial upside potential. That's definitely a stronger sentence than the first one. Here are the daily rates. When it says scrubber premium, not all ships have scrubbers on them. A scrubber is a gas cleaning system that removes particulate matter and harmful substances, like sulfur oxide and nitrogen oxide, that are emitted from the ship. That's why it's more valuable to have a scrubber on the ship. It's better for the environment, it's more eco-friendly. The current market narrative, global supply increasing, demand growth muted, and trading patterns changing. Geopolitical risk linked to the Middle East continues. U.S. policy important going forward. 17% of shipped oil is sanctioned, which is 6% of global consumption. A sanction is like a restriction. It's a rule you have to follow. For example, the US may sanction a certain amount of oil to be shipped to Iran, or they may sanction a certain amount of gold being shipped to China. Tariffs on Canada and Mexico may increase inefficiencies in oil flows. Tariffs are additional taxes. World oil trade is serviced by the oldest fleet in more than 2 decades. When the fleet gets old, that means the ships will get scrapped and there's less supply. When there's less supply, then rates go up. When there's more supply, rates go down. Same thing with demand. The higher the demand, the higher the rates. The lower the demand, the lower the rates. As long as demand stays high, this company should do well, assuming supply doesn't get out of hand. The way supply gets out of hand is when other companies buy vessels or new companies enter the picture and add more vessels to the total population. This is the entire population of ships. There are 883 VLCCs all around the world, not just this company. 295 are over 15 years old, so 1/3 are over 15 years old. 15% are over 20 years old. And there are 67 VLCCs that should be manufactured in the near future. There are 611 Suezmax, 39% above 15 years old, 18% above 20 years old. And 95 are being worked on to be introduced probably next year sometime. LR2 445, 29% above 15 years, 7% above 20 years. So the LR2 seems to be younger than these two. 679 Aframax, more than half over 15 years old, a quarter 20 years old. And 36 should be introduced fairly soon. So that means 40% of the entire population of ships is over 15 years old. If a lot of ships get scrapped over the next 5 years, shipping rates will balloon. This gray line on the bottom shows you the number of ships that were scrapped. So in 2023, not many ships were scrapped. Only 1 Suezmax, no VLCCs, and 2 Aframax or LR2s. The way they present this chart, it looks like a lot of ships will get scrapped this year and the next few years. I think that's what they're trying to convey. Or maybe they're just saying ships that are over 20 years old. So 108 Suezmax are over 20 years old. Okay, right here it says 108, 20 plus. To summarize, it's a roller coaster bull market or a roller coaster bear market. They have a modern fleet and strong balance sheet with upside retained. Oil supply expected to outpace demand in 2025. That's the most important thing if supply beats demand. Current trade flow developments challenging as sanctions bite. Policies changing in the Middle East, maximum pressure 2.0. That must be worse than maximum pressure 1.0. Maximum pressure 2.0 is Trump's fight against the Iranian regime. We may bomb Iran. Iran has said they plan to assassinate Trump. This chart shows the average weighted earnings of all tankers. The peak was 2004, almost $45,000 a day. It was high in 22 and 23. Remember, shipping stocks were doing really well. I know Zim did really well. But rates are pretty decent in 2024. Much higher than what it was from 2009 to 2021. Let's look at a stock on Simply Wall Street. Its last price, 3.2 billion market cap. Up 4% in the past week, down 31% in the past year. It looks like they started trading in December 2015 at $14 a share. Hopefully you didn't buy it then, because 8 years later, it was still around that same price. Its low point was in 2018 at $4 a share. I bet if you looked at other shipping companies, they also came down a lot in 2018. Shipping companies usually move with the price of shipping rates. Its all-time high was in May 2024 at $29, and it's down 50% in 7 months. It's pretty much cut in half from that point. So how much lower can it go? When's the good time to buy into this stock? It could be now. Simply Wall Street's bullish. They're at $44 a share. They say the stock is 67% undervalued. 7 analysts priced this stock at $28. They also say it's undervalued. The free cash flow is projected to be $1 billion in 2025, almost $1.1 billion in 2026. If it did hit $1 billion, the stock should go up to like $50. You can make a 3 or 4x return on the stock in just 1 year. Here's their revenue since 2013. It was $134 million, and then it grew steadily up until 2020, $1.4 billion. It came down to $749 million in 2021, and their revenue has grown a lot to over $2 billion as of the trailing 12 months. Here's their debt since 2013. It was $600 million. And it pretty much goes up each year steadily. It was up to $2.2 billion in 2023, then jumped up a lot to over $4 billion in 2024. Now it's $3.8 billion. Their equity is $2.3 billion, so their debt is 160% of their equity. And they don't have that much cash on their balance sheet, only $326 million, which is about 9% of their debt. They usually pay a really high yield. In 2015, it was 8.9%. They were paying a 25-cent dividend that quarter. It got up to 21% in 2016. They raised their dividend to 40 cents. Then it looks like they cut their dividend in 2018 and 2019. They brought it back in 2020, and the yield was up to 39%. Then they cut their dividend again in 2021 or 2022. They brought it back in 2023. According to this chart, their yield is 10%, and they pay a 34-cent dividend. And they're forecasting a 20% yield by 2026. The CEO's salary is around $400,000. Total compensation $2 million. Tenure as CEO 4 years. 38% of the company is owned by the general public, 36% by insiders, 21% by institutions, and 5% from the government. The biggest shareholder is the former CEO. He owns 36% of the company. Vanguard 2.5%. The Norwegian government owns 5.3%, Fidelity 2%, 2 Sigma 0.6%, Dimensional Fund 0.3%, and to round out the list, Avantail Capital Group. They don't have that many employees. It was 123 in 2015. Now it's down to 88. And the ticker trades on the New York Stock Exchange, Oslo, London Stock Exchange, Deutsche Börse, Mexican Bolsa, the Stock Exchange in Stockholm, and the BATS Europe. So if you want to get a copy of my discounted cash flow model, click on the video in the top right corner. Thanks for watching.